Hello and welcome to the monthly macro and markets call. In the last 1 month, the slowdown talk has grown louder. The volume growth of the FMCG companies have come down to low single digit rates, and it has come along with the commentaries of adverse rural demand conditions. This year the monsoon is expected to be at the lower end of the normalcy, and therefore the talk of rural slowdown might in fact accentuate. If we look at the private capex, that has not picked up meaningfully as yet, and the government capex, the sectors that were dependent on those, the road, the railways and the affordable housing have received a lower budgetary allocation this time. Given the global trade slowdown, the export prospects are not too rosy either. Therefore, none of the major levers of the economy are working at this moment. And in fact, if we look at the vehicle sales, there every month across categories, whether it is commercial vehicles or passenger vehicles or even two wheelers, they have degrown. The fact that the sectors that are employment intensive are hit the most, for example, agriculture, manufacturing or trade, also points to the adverse consumption loop that is working in the economy at present. In this situation, it is important to count the positives, and there are a few. First, the sentiment related indicators, whether the consumer sentiments or the business sentiments, haven't really taken a knock. In fact, they have improved in the last quarter and the month. If we look at the banking sector, that is coming back into profitability, and given that the deposits are being seen as a safer form of investment in the current situation, means that the deposit growth will be healthy, and the banks will have a capacity to fund the credit growth. The project completions have picked up, and the capacity utilization levels are also inching up. Therefore, the corporate sector margins is another factor which has expanded, in fact, for the 250 odd companies for which results have come so far. But overall, the positives and the negatives taken together would still imply that the growth, that the GDP growth rate will perhaps slow down to 6 to 7% level in FY20. Going forward, the adverse geopolitical developments will find its reflection in higher oil price. However, given that the domestic inflationary situation impulses are not there, it might counter any kind of oil price related inflationary impact that might be coming. However, the fiscal situation will come under stress. There is already a 2.5 trillion rupees of subsidy arrear which is hanging on the new government, whichever assumes power post May. Further, the new government will also have to come to terms with some form of basic income support, for which a political consensus have now built up. Given these two fiscal stress points, the restraint on the fiscal deficit will have to be lifted somewhat, and whichever government comes to power, that seems to be the base case. Meanwhile, the monetary policy will have to be stepped up, and with further rate cuts and more aggressive provisions of liquidity from RBI is expected, as well as more counter cyclical regulatory measures. So, these policy interventions, both from the government side and the monetary authorities, are crucial to break the negative feedback loop of intersectoral interplays that are happening in the economy right now. Thank you.